Welcome to the CRE with CBC Worldwide podcast, MidYear Outlook Edition. I'm your host, Jenna Hille, Director of Strategy and Operations, and I'm joined by our Senior Vice President and Managing Director, Dan Spiegel. We recently published our 2026 MidYear Outlook report, and there's a lot to unpack. A real jump in transaction volume, a widening spread between the primary and secondary markets, and sector trends that don't point all in the same direction. If you're a groper or an owner trying to figure out what this means for your next deal, this episode is for you. So Dan, let's get started. Transaction volume is up 19% year over year to 117 billion in Q1 of this year. What separates a market that's part of that 19% from one that isn't?
So, hi, Jenna. Great to
Hi.
be here and great to have another conversation about the market. I mean, we started this year with a podcast. I don't remember what date we launched that, but here we are mid-year already, and inevitably things change. So that's what today's conversation will be about. Now we're recording this in the first week of July, so we don't have second quarter stats yet. So we're still only relying on first quarter, and these things can change pretty dramatically quarter to quarter. So that's just my caveat. But what was driving activity earlier in the year, and by the way, the first quarter of the calendar year is typically the slowest in commercial real estate. The fourth quarter tends to be the highest. So take that with a grain of salt. But just looking at that period year over year, I think what we had anticipated for that quarter, and we were starting to see, is people were sort of tired of being on the sidelines. The prior year, there was the interest rate shock, the inflation shocks, whatever, all the other things that were going on in the world. And often when those things happen, investors go, hey, I'm just going to sit on my wallet, so to speak, and just wait and see. Sellers are like, yeah, can I get the price of 2 years ago? Buyers are like, hey, am I going to get a deal? It just kind of things slow down because people who aren't forced to make a transaction can wait, right? So we started to see that change when people start to get realistic, like, okay, this is the world as it is now. And we started to see that volume pick up in the first quarter. As I said, I don't know yet if we're going to see a continuation in the second quarter until those numbers are finalized by the various sources we get numbers from, in addition to our own Coldwell Banker Commercial numbers. But yeah, we'll hope for the best. How's that?
Yeah. And what would you say would be some of those key drivers in those markets that are doing well? So what makes a market outperform another market right now? And based on the information
Right.
we
So
have with a grain of salt.
right. So I think there's a couple things going on. So you're pointing to the fact that one of the topics of the report is that activity is very inconsistent by geography and by property type. So, I mean, I can take markets, big markets, for example. Let me just give some good examples. Let's take the office market in big cities. Well, most big cities are really the downtown markets have been suffering for office for since the pandemic, right? The whole, return to office or not return to office or downsize or whatever's taken its toll. Now, that said, markets like New York City and markets like San Francisco, where there's been a uptick in activity of particularly AI related industries has really picked up. So that's a great story. But if you go to downtown Denver or downtown Dallas, or even for you and I here in Chicago, vacancy, I think it was just announced that vacancy downtown Chicago started to tick down, but it's still well over 20%. So there's still a long way to go. So that's just one example, but you take that across retail, office, industrial, large product, small product. There's just a lot of variation that we saw across the country, or we see across the country. And so there isn't necessarily one story in commercial real estate at the moment.
And you spoke about that split in how buyer motivation is showing up. Everyone's tired and they kind of want to transact. We're seeing more sellers in the market. How is that affecting some of the pricing?
So pricing is, pricing has softened definitely over the last several years if you go back in time. And that's just because the market activity slowed down, interest rates are frozen, so on and so forth, right? So definitely things have changed, but there's other dynamics going on besides pricing. Now, again, pricing is still very specific to a market. Let me just give you, by the way, some other examples. I just spoke about office space, but I traveled not too long ago to some of our markets where we're in that are smaller markets. So Palm Springs, California, El Paso, Texas. Where else was I? Victorville, California. I was in Ormond Beach, Daytona area in Florida. Gosh, all of those markets in the office space, like I think in Palm Springs, their vacancy is like 2%. And so again, that's just a very wide uh, dispersion of pricing across the country just in terms of one product or asset class. And we see that, and those are just simply factors of supply and demand in those markets. So that's just one factor. Obviously, there's other factors like job growth, interest rates, cost of construction. All these things are contributing to either a lack of new product, which means what there's available is scarce, or lack of demand, which means there's too much of things. It's just a wide variety across the country. So there's a lot of things to take into consideration. Again, local brokers certainly know the best because there is a lot of variance and nuance by market.
And what other, you kind of touched on Florida a little bit. What other kind of markets in that area are doing well?
Yeah. So one thing we found, and this is, sort of, I will say bodes well for our brand, Coldwell Banker Commercial, because a lot of our presence is markets that are underserved by larger commercial real estate market companies, rather, the secondary and tertiary market. So I mentioned a handful of them a moment ago. We could go to McAllen, Texas, or Janesville, Wisconsin, so on and so forth. All these markets that are out there across the country that are, not tiny, but smaller than big cities. And all of those across the board are doing pretty well. Now that has been a trend that started before the pandemic when capital, deals on the coast in the coastal markets, as they're known, be it the West or the East Coast. Cap rates were low and people were like chasing returns and they were going to smaller markets. So that was one trend of several years. This is not new, but what's now is some of the issues that have been facing, as I said, in office space, for example, in the large CBD markets just aren't a thing in the smaller markets where a large office building might be 30 or 40,000 square feet as opposed to 800,000 square feet. And the users might be local users of law firms or or services companies and things that don't really deal with the same back to work issues or back to office issues that larger companies do. And the demand has been pretty solid.
Yeah, in terms of closing that gap, do you see any signals or indicators on where that might go?
Yeah, that's a great question. I wish I had a crystal ball, so that's a great question. I think, first of all, a lot of what has transpired in the last, I think it's because it's 5 years since the pandemic, is just geographic shift of people, right? Where people have moved, and we know, from statistics that are out there, published public statistics, Florida, Sunbelt markets, Texas have all taken in population. And where there's been an influx of population, there generally has been an increase in demand in commercial real estate, right? So retail centers and apartments, multifamily, although performance of multifamily has been varied across the country. But let's just say in general, where population has shifted, investment has shifted from commercial real estate as well. So those are some of the trends that I don't know. I mean, I think that shift that was driven a lot by the pandemic definitely is sort of cooled. I don't think, there has been some stories about, return to San Francisco, Chicago, New York, whatever it may be, but I don't think we're going to see some huge reversal in the near term. So don't expect that to change. But there are, as I said, industries like AI, which you maybe is driving a lot of employment in San Francisco or New York, for example, is going to be a factor for sure. And even here in Chicago, Jenna, there's for the first time, I don't know, it was announced maybe 2 weeks ago that there's going to be potentially a new construction high rise office space in the Fulton Market area, which is sort of the latest hot market in, around downtown, which is interesting. So in the same market that's got 20+% vacancy, we have a new Class A construction office building, but that's because the building will be suited to people who want to be in that location with the amenities and technology that they expect today, which means the Class B and C buildings that are left are really the ones that are going to be struggling to find a new purpose in life.
And that's part of the split in office that you were talking to earlier. Those small, high quality spaces are actually leasing well, and it's those bigger legacy ones that are struggling to find.
Correct. That's just another example, right? There's differences in small markets and big markets. There's difference in small users and big users. There's difference in high quality, as you just said, high amenity Class A buildings and Class B and C. So there's all these little nuances, and I would call them bifurcation, but there's probably more nuance than that um, that are driving just sort of different results in different markets. And it's just sort of that's the tale of what we see mid-year is sort of inconsistency about the performance across the country, even though overall it still seems to be doing fairly well.
Mhm. And that kind of transitions well into the multifamilies tale of two markets, so to speak, in the orbital and the workforce housing that's leasing fast. And then the luxury units in the Sun Belt. Talk to me a little bit about that oversupply.
Yeah, yeah, so again, just like I've been saying, multifamily is another one that's got a lot of stories to it. So again, you can take, right, clearly we hear about the stories in the news, be it big markets like Chicago, New York, LA, San Francisco, that, scarcity of housing is an issue, cost of housing is an issue. There hasn't been enough building to keep up with the demand, so on and so forth. Okay, so that's definitely one story for sure. Another story in the Sunbelt states, Austin is the most prominent example where sort of overbuilding of multifamily led to a decline in rental rates over the last, I think, 6 or 12 months. Although I think as we look at, and that happened in some other southeastern markets or central to southeastern markets, but I think as we look out towards the future, as construction has slowed, for a variety of reasons, demand, cost of materials, labor, and other things, it'll catch up because, as long as, the flip side of the high cost of owning housing today is the fact that people rent longer or they may rent out of choice. They may say, hey, it just doesn't make economic sense to put my nest egg, so to speak, into buying a home or a condo. I might as well just rent. And if I'm going to rent long term, I want a nicer building. I want amenities. I want a gym. I want, whatever else comes with that. And so that's kind of what we're seeing, right? Is people are okay. So though even in the markets where there's a supply and demand issue at the moment, we anticipate that will even out certainly over the next 12 to 24 months in those southeast markets, and things will even out. But I don't know if I will say I'm bullish on multifamily, but I just don't see a slowdown in demand for rentals until there's a change in pricing of for purchase housing. And people will tend to, as I said, rent longer, want bigger spaces, and want more amenities.
And, in that same vein, transitioning to land, getting more strategic because of those high construction costs and rates. Talk to me more about where that's going.
Yeah, so land, we do a lot of land just because of the markets we're in. But land is, and while land is gosh, for our company is around 20-25% of our business, it is slowing down a little bit for all the same things. I mean, these things are all interrelated, same factors I've mentioned. So you have cost of construction, materials up, right? Lead times on delivery of supplies and things up, cost of borrowing up, right? So all these, there's a number of factors I'm just pointing out. I call it labor, availability of labor, insurance costs. Sometimes the cost of insurance is 3 or 4 times, the insurance while you're constructing, because you do need insurance during construction as well as after. I mean, those costs. So all those things figure into a developer's equation, and they may just say, you know what, I'm not gonna either I'm gonna land bank, I'm gonna sit on the land I have, or I'm just not gonna buy more right now because I don't know when I'm gonna be able to develop it. So, now that said, that's one type of land, development land. There's obviously land for recreation and other purposes. That's a different, it's kind of a cycle in demand. But by and large, the land for development activity has cooled a little bit only because the things that go into developing have made development just more challenging.
Mhm. And you did say that there was also that growth in those areas where there's those catalysts for growth. So the sports complexes, the new headquarters for a company moving, but the sports economy is huge with everyone getting a new stadium, it seems. Where do you see
Yeah.
that and being the most impact?
Yeah, I mean, that's interesting. I mean, a lot, there's where you and I live in an area where sports stadiums are a hot topic right now. Uh, but at the end of the day, I hate to say this, but yes, owning a professional sports franchise is a business, and part of that business is the real estate. And that's the story across the country. And these stadiums are expensive, and they take a lot of public. They can take a lot of public resources. Not all stadiums require it. And they're, in a sense, they're kind of economic development engines for parts of a metropolitan area. I think we'll see that here in Chicago with the Chicago Fire. I believe New York's getting a new soccer stadium. It's a great year to be building a soccer stadium, given that the World Cup is going on as we speak. Certainly, the momentum is on their side, and those are going to be sort of catalysts for in the neighborhoods in which they're being built. But you also have developments. We actually our company represented the buyer of a hotel in downstate Illinois. And I was like, oh, why is that? I was curious. I talked to our professional that handled the deal. And it was around those, I guess we'll call them amateur sports complexes that are built in areas where people drive their kids on the weekends to do softball, hockey, whatever it may be, right? and anybody that's traveling needs a place to stay, so they tend to stay in those sort of mid-price, mid-tier price hotels, and this happened to be a client of one of our professionals that said, "Hey, I wanna buy into that," because that's a so very different kind of sports altogether than we were just talking about, but in a sense, all these things have every decision has a real estate impact, just a matter of where in the food chain that transaction takes
Yeah,
place.
where we see that ripple effect. And we have to talk also, and if we're talking about growth catalysts, it's those data centers, not really their own asset class in a breakdown, but definitely a driver worth watching. Are we seeing that show up in deal flow
Yeah.
directly or
Yeah, great question. We can't have a conversation about real estate right now and not talk about data centers. Now, it is its own asset class. I mean, I think different firms are tracking it now. It's not something that would have been tracked 3 years ago, but is definitely being tracked today. And it's a little bit of a puzzle, right? Because the way I describe it is there has been a race to get secure land and to build data centers, not to mention energy, which is a key factor in delaying the building. So someone, for example, a data center developer can secure the land, but they may have to wait a year or two to get the utilities necessary to that site to actually activate the data center. And then while that's going on, just like a lot of things, there's opposition growing for whatever reason. I'm not going to get into pros and cons, be it water, lack of employment growth, energy prices, whatever the topic du jour is. There has been building a lot of reasons for communities and legislators to go, whoa, slow down, slow down. So there was a big race for data centers, and then there's a little bit, we're obviously all using it, so I think the demand is there. But then there's been a fair amount of pushback in different parts of the country to say, whoa, we got to think about to make sure this is a right investment for us. I don't have a particular outlook for data centers. I will say one thing that's on my mind is I think about how quickly the technology has changed, how quickly we've all integrated using AI into our lives, right? Be it our consumer lives or our business lives. And it makes me think like 2 years, I don't know what it's going to look like 2 years from now. Maybe the data center of 2 years now is going to need to be half the size. I don't know yet, right? We know the semiconductors and processors and things are in short supply. The values of those companies are up super high, but it also means what they're building today could be obsolete in 2 years. I don't know, right? We're going to have to find out how that goes. I mean, certainly things, it's just century. The world is changing faster than ever, right? What malls were all the rage in the 70s, and it took 50 years before they became obsolete and people started tearing them down. The life cycle of a data center could be very different. I don't know. I could be wrong. Could be 50 years, but it also could be 5 years. So we're going to have to wait and see what's out there for it,
and
for
I'm
that product.
I'm glad you brought up I mean, first off, that was a great, like, comprehensive picture because you do have to think about, the energy and, the politics and the geography and all of those different factors, but you brought up malls. Are malls coming back?
So that's just a funny topic to me. Retail in general has come back. Okay. I mean, I say it's a funny topic because I'm a product of, child of the 70s, right? Where the hangout place was the mall, right? So that was the new shiny thing in the 70s and 80s, right? To go hang out at the mall, whichever kind of mall it was. It drove a lot of decline into urban or suburban downtown neighborhoods, so to speak. But malls had a heyday, and particularly, is it 5 or 7 years now? The decline of large department stores, which were always the anchors at every mall. There was one on every end. But pretty much most of those have struggled or gone away, right? There's struggles across the board. Consumers prefer to shop online or purchase, I should say. They prefer to purchase online, even though they like to experience goods in person. That's sort of a different topic. But the malls in general, listen, malls that are well located and I guess appropriately tenanted for their geography. I can think of one, in California near where I grew up, that's 100% full. It's 100% full. It's booming. And yet other ones have been demolished for purposes of residential, distribution centers, whatever it may be. So maybe the fact is we were overmauled in America. If they're still well located, they can do well. And there has been a little bit, I've read a little bit about sort of a resurgence in interest in malls, but they're going to be a different kind of mall than they were, as I said, when I grew up. They're going to definitely have more experiential elements to it. Maybe they'll not be covered. Maybe they'll be open. That sort of depends on the climate of the area, the location. And there will definitely there are fewer of them and there'll continue to be fewer of them. I haven't seen anyone newly develop a mall. I may be wrong. Maybe someone will comment below in on our podcast to say there is, but by and large, we're just trying to figure out what to do with what we have. As I said, start at the beginning, that doesn't mean anything about retail because retail in many markets is doing super well.
Yeah.
Grocery anchored centers doing super well, right? Experiential, I touched on retail of where you go to the location or store that you experience the Harry Potter or the Hello Kitty. And here in our city, there's a new Hello Kitty cafe. Oh my gosh, I walked by, there are 80 people in line to get inside, right?
Yeah.
So anything that's a little bit of a attraction, if you will, it doesn't mean they'll buy the Hello Kitty products at the store. It just means they're gonna experience it at the store, and that helps carry the brand, and that's certainly what we see in major city markets here in, Chicago and Michigan Avenue, but also other markets. You need to have a place for people to experience the brand that they in turn buy online.
Yeah, I remember, I mean, I had the Rainforest Cafe and kind of all of those experiential retail or those dinner shops. Now there's, magic ones too, and all those experiences to get people out, the pop-ups, as they call them, in different areas, even in like parking lots, not even in malls, trying to get those.
Yeah, that pop-ups is a whole whole 'nother thing, right? There's so many I think retail's fascinating just because it changes, consumers are fickle, right? What's here today is gone tomorrow. Um, And look, I think about, whether there'll be someday someone will say, "Yeah, we need department stores, places where you can go get everything done all at once," right? For all I know, that'll be back, right? Amazon bookstores have come and gone. Is it Borders or the other one? Barnes and Noble's back. Barnes and Noble, who knows what the consumer? I think consumers are very fickle. One thing about retail is there definitely tends to be some leaning towards higher end retail, and that's just because of, economic conditions. Those with more means tend to be more able and willing to shop and spend money, and those with lesser needs have been looking at value retail, so that would be the Walmarts and Targets and things like that.
Sure.
Not different than the past, it's just been more pronounced perhaps than the past.
Yeah, that's a good point to make as well. I think we also hit on, let's see, we hit on industrial, we hit on multifamily, we touched on office, touched on land, office, data centers. We mentioned AI. Is there anything else
Yeah.
that you want to mention as a?
Well, I'll just double down on industrial for a second, just because industrial, has been the darling of the institutional investment community for, I don't know, all the way through the early pandemic years, building what probably pretty much everyone in America knows are those large distribution centers you see on major highways. They're in commercial real estate terms, they're 42-foot clear, concrete tilt up. They're big, right? They're for all the distribution of, be it Amazon or any other Wayfair, any of those other producers. So that product type had its day. It still has its day, although the development of that product has cooled a little bit, and the demand for it's cooled a little bit. Like we kind of sated that demand. But what we have seen lacking, and this is true in industrial and in office, is sort of smaller space, smaller divisible industrial. So in industrial, that could be a space of 5 to 20,000 square feet. If you go to a lot of markets and talk to their brokerage professionals, they'll say, "Dan, there aren't any spaces like that. That hasn't been what's been built, and that isn't what's available now." And by the way, that's also true a little bit of office space where there are some large blocks of office space, but finding small blocks is not always easy. A little bit different story than industrial, but I think those are two things just to watch because I can imagine an increase in development on the industrial side of kind of divisible, smaller buildings with spaces that can fit a more moderate sized business than just the large distribution companies.
And that would be more opportunity for those smaller businesses to be able to expand their footprints as well without.
Yeah, for whatever the use is, there could be a lot of uses of those, but again, there's only so many companies that can occupy 800,000 or 1,000,000 square feet. That's a big building, right? I see them on highways. We all do across the country,
Yes.
but there's a limited number. We built, the country's built out plenty of that. I'm not saying it's overbuilt. There's also been the uncertainty of, the tariffs and import and export, and that is a fair amount of what drove demand for those warehouses is bringing things from overseas and storing them, waiting for distribution in the US. So that business has sort of been in flux over the past, what, a year or so. Obviously the economic world will settle out on that at some point, but it's just slowed the demand,
Right.
right? Because companies don't know what their needs are going to be for storing imported goods. But again, those small spaces that are for local operators, those are the ones that just there's not enough supply, and that's primarily in industrial, but it's also true in some office space.
Well, and then to your point earlier, that's where we're seeing those empty warehouses around the coastals. They're just sitting there with the trades probably because there's not as much going on.
Yeah.
Maybe it's
The vacancy is definitely ticked up in industrial, but, let's just keep in mind, it's ticked up from lows of 1% and 2%, so I don't wanna, Inland Empire in Southern California is a great example, just because vacancy may be, and I don't happen to know off the top of my head, I'm gonna guess around 5 or 6%, off the top of my head, that's not a crisis, right? That's not like 20 plus percent vacancy in Class B office in Chicago, right? So, there's definitely a lot, as I said, a lot of different stories, depends on the market, depends on the location, and I guess I can certainly say more than ever, that's why local, community-focused commercial real estate people are valuable because what you read about in the papers isn't necessarily what's going on for you down the street.
right. Because we're seeing capital is now active and deals are closing, but it really is dependent, to your point, on the hyper-local knowledge and realistic pricing. And there's not really a national trend going on here. It's different market by market
Correct.
geography.
That's right. Yeah, and by the way, you mentioned capital. There is capital, like, flowing. We in our conversations with professionals, they say that. But we've also heard is it's very much contingent on the fundamental operating economics of the property, right? So there's not so much availability of speculative capital, or not as easy. But the lenders are definitely looking at rent rolls, cash flow, that kind of stuff. And if it's a solid performing property, they'll lend on it. If it's something more speculative, maybe the borrower will have a little more challenge trying to find a lender willing to make the loan.
Sure, lenders focusing on more well-capitalized players that have those long-standing relationships and are less risky right now.
Yeah, they're just that's the way banks are. They go through phases of taking more risk or less risk, and right now they're looking at the fundamentals. That's how I describe it for sure.
And if you're advising a client, a buyer, a seller, an owner in the next 6 to 12 months, what's one thing you would like them to keep in mind or you would advise that they keep in mind during this market?
Oh, I mean, listen, that's just tough because, we're 6 months into the year and what we're talking about today is different than we talked about 6 months ago. So I don't, I guess my advice would be simply consult with a local expert, because, and it's true. Every city, every place in the country, probably the world as well. But there's nothing like someone who really knows locally. I mean, again, financing may be a challenge, but maybe they know a building that's seller financed, right? That's an option out there that may not be advertised. A lot of nuance to it. Rely on that local professional who has the expertise, when it comes to investing, when it comes to user space, things like net lease and so forth. That's a little bit less necessary because the product's a little more homogeneous across the country. But most real estate, as they say, is local, local, local. So definitely rely on people who know the market.
Yeah, that's a great final point to wrap up today's episode. Thank you, Dan, so much for breaking this down and sharing your perspective and all the great knowledge that we have. This was a really great conversation.
It's always fun, and I kinda smile if you could see Jen and I right now because or 6 months, it'll be a different conversation. I have no idea what it's gonna be. We do our best to try to and by the way, Jenna, when we put together our outlook, we don't just look at numbers that are published. We really go deep and interview people, interview our brokerage professionals, market after market, to try to call what they're hearing from clients. So a little bit different, than another type of report that might be out just based on numbers that are backwards looking. We actually do interview our people across the country, markets big and small, to try to understand what they're experiencing, what they're hearing. Now, that's only good for a couple months because the markets change, but I think that does make our insights kind of super interesting.
It really does. And that's a great point. We're really boots on the ground in the market there. So, to Dan's point, make sure you find your local expert. If you would like to dig deeper into the full 2026 Mid-Year Outlook report, it is available on cbcworldwide.com. And if you found this episode interesting or informative, make sure you like, subscribe, and share. It really helps more people find us in the show. So until next time, thank you everyone for listening.